All right, we're live. Okay, this is the trade zones for 1st of May 2023. My name is V. I'm from Track Record, and we're going to talk today about a few things. It's just going to start off simply for the month of the week about what is the point of trading and how do we make sense of markets, what was important last week, what was the market impact of the important events, and what we're looking forward to this week and how it will impact the market, right? So how do we make sense of markets? Quite simply, we use both fundamentals as well as technicals. Of course, when I say simply, it's not that simple, but it takes time to figure out what exactly are the fundamentals that are driving the markets. And technicals, of course, if you have been trading for a while or if you're just starting out, you may be still trying to figure out what are the technical indicators that you should use. There are many technical indicators, but we won't be using complex ones because it takes a lot of time to figure out what's good for your trading style. And also, technical indicators are usually created during periods of markets where, and it's most suited for that period of markets that it's created in, right? So if it's a trending market, trend following indicators will work. And if it's a range markets, all the range trading indicators will work. So it's not one indicator for all sorts of markets, right? So you have to figure out what are the ones that are useful for your trading process. So let's dive straight into it. What was important last week? Important last week was the debacle of the First Republic Bank. It is a bank in the US which reported that it had a withdrawal of deposits to the tune of the total of more than $70 billion in earlier in the week, and they had only $170 billion for the first quarter. So that was a big drop from 170 plus to 100, and that led to a sell-off in the stock prices. And we shall see how terrible how aggressive the stock prices fell, and that influenced risk sentiment. So this is one thing we have to understand, is that many events, many occurrences are linked within the market. So it doesn't matter. That's why we employ both technicals as well as fundamentals. Of course, the true technical analyst always says that it's all in the price, it's all in the charts. But I find that it's good to know what exactly are driving the charts as well. The other important event for last week was the Bank of Japan monetary policy decision. But let's just go back to the First Republic Bank. First of all, you can see from April in March, when we had the first few US bank failures, the stock price fell more than 90% from above $120 to just above $10 to $15. And last week, it continued with the release of that news that it dropped by quite, the deposits withdrawal continued to accelerate. We saw that the stock prices dropped from above $15 to less than $5, right, by the end of market close on Friday evening in the Friday New York hours. So that was affecting market sentiment. In general, I think the contagion is contained for now because the policymakers have shown resolve and quick action in trying to stem the panic. But this remains a problem that continue to trouble the market, because the problem with all these banks is that interest rates are much higher than the environment when they started making loans and buying lots of government bonds, which essentially are just loans to the government. So they lend money at much lower interest rates, and now they have to borrow at higher interest rates to fund this, to fund all these loans. So that's why they are bleeding to death, so to speak. So as a result, the issue, although it's now just concentrated on First Republic Bank, but it is across the industry, especially the smaller banks. They still have this underwater bond portfolios, and they still continue to bleed deposits because depositors can find much higher interest rates from other money market funds, as well as, for example, even Apple has opened a new online bank which pays deposits, which pays more than 4% on cash deposits. So this is a problem that we're going to hear more of in the weeks to come. So the Bank of Japan policy decision that caused a big move in the dollar yen, because it was the first meeting for the new governor, and there was a lot of expectations. There were expectations that he could possibly hint at a policy change at some point this year, especially given that inflation is now quite high above the inflation target of 2%. But unfortunately, that hopes were dashed when he kept policy unchanged, and he reiterated that they will continue to ease policy, i.e., that is, they were going to print more money if required, without hesitation. So that's a bit of a disappointment for yen bulls who were thinking that with the new incoming governor, it's possible that policy will change at some point in time this year. And most troubling for the bulls is that the committee said that they will do a policy review, but the policy review will take around 1 to 1.5 years. So it's kind of their hint that they're unlikely to make a decision, any policy change anytime soon. And because of that, yen bulls, people, speculators who are long yen, hoping for dollar yen to fall further, for yen to strengthen against dollars, the euros, were sorely disappointed. And we saw here the candle on Friday as well as today. It was a big move from below 133 to currently around 136.90 plus. But the resistance that we see, a simple resistance, just drawing a straight line connecting all the previous tops from the past. It's around 138 figure to 138.10. So although fundamentally now it seems to make sense to continue to be bearish the yen, because the Bank of Japan remains the only major central bank that is easing policy, while all the others are hiking interest rates or have hiked interest rates by a lot and continue to remain hawkish. So this divergence in central bank policy is driving the yen weakness, and we are seeing more interest to sell the yen, but they likely will be buying dollars against it on dips rather than chasing it here, because we have a strong resistance level up here at close to 138. And that was the chart on the daily basis. On the weekly basis, you see as well, it is the case. And for those who are not familiar with the charts that I'm using a candlesticks chart as well as the Ichimoku chart. And of course, these colorful lines here looks cool, but it's just a form of moving averages projected into forward time space, right? So it is calculated from previous prices and projected into the future on the chart. I use it because it is a form of moving average. It defines the resistance and support based on previous prices. From this, you can see when it is within, it is called the Ichimoku cloud because the span here looks like a cloud projected into the forward space. When it's within the cloud, it's no man's land. Essentially, it's unlikely to stay within here for a long time. So it's a mixed picture. But on the daily picture, it is an uptrend because it's above the Ichimoku cloud, which is the moving averages resistance and support. So when a price is above, it is a support level. So likely, if anything, in the days ahead, if it should dip, we will be looking to buy if we are looking to long dollars against the yen. Okay, so what's important this week? It's Monday now, 1st of May. It's a holiday in quite a lot of time zones. A lot of countries, of course, London is off as well. So expect reduced trading activity. But of course, volatility will be high given that the US government, US authorities is likely to announce a rescue package or resolution for the First Republic Bank. We should be hearing more on that when the New York hours start to, when the New York trading market starts. But the most important event of the week is the US Federal Reserve policy meeting on Wednesday. This would be Wednesday in the US time zone, so likely in the wee hours of Asian time. And expectations are for a rate hike, but we'll show more on it in the next slide. And the other important event is the US non-farm payrolls, which is a jobs number that is the key number at the start of every month that shows how many jobs were added to the US economy in the month before. The US policy, Federal Reserve policy meeting, using the CME tool, you can see that the probabilities for the May 3rd meeting is for a hike of 25 basis points. Currently, we are at 4.75 to 5% interest rates, and for it's likely to go to 5% to 5.25, which is a hike of 0.25%. And it is showing a probability of more than 80%. So the market, using market pricing of the futures instruments that trades according to the interest rate, the Fed funds interest rates, it is showing that the probability of a rate hike as priced by a market is more than 80%. And it's likely, given the comments that we have been hearing from the Federal Reserve policy meeting, committee members, the voters especially, they have been talking about one more rate hike at least, and then trying to see and becoming even more data dependent and think of what future decisions will be based on the evolution of data points, as well as how the market reacts to tightening credit conditions because of the banking troubles. But we can see, you can see this chart. I'm going to paste the link here. You can see this chart in this website, and yeah, you can always refer to this for more. You can play around with the tool as well to see what are the expectations from the market pricing in the months ahead as well. So it's a very useful tool to not just hang on a second. I don't seem to be able to send it to. Okay, it is on CME. You can just search the CME tool and doesn't seem to be able to send to the public comments. So you can use this tool going forward as well. You'll see that, in fact, if you changed it to the months ahead, you will see that there are a lot of rate cuts priced for the future. This is the most rate cuts being priced in the last 37 years. And it is because of the divergence of market views relative to what the Federal Reserve Committee is thinking about the state of the economy, as well as the state of the banking sector, and also how the market will react to tightening and tightening monetary conditions, as well as the lagged effects of the previous rate hikes. So the market is saying that they believe that although the Fed will continue to hike for now, it is likely that they're committing a policy error, given that we are seeing cracks in the banking sector, even though the Fed assures us that it is not a big deal, that it is still their primary focus remains on keeping inflation under control. So, but in the days ahead, we'll be talking more about this, because the interest rate hiking cycle is even by their own admission is towards the end of the hiking cycle rather than the still in the middle of it. And it is what tends to happen during the end of hiking cycles is that the market will price for aggressive cuts at some point, because the effects of previous rate hikes takes time to be felt in the economy, and we are now seeing more of it, and we are seeing cracks in the banking system. We've seen so far 3 and coming to 4 bank failures, and this is likely going to continue as long as the high interest rate environment remains. So, what other concerns do the Fed have? Their primary focus for their primary reason for hiking interest rates has been the high inflation above their inflation target of 2%. And the reason that they are confidently hiking interest rates is because of the extremely strong jobs market that we've been seeing in the past year, as well as the start of this year. But as you can see here, the number of jobs, this is the number of jobs being created in the US economy. The number of jobs that's being created has been falling, and though it is still at a healthy clip, above 200,000 jobs being added, you can see from here, it is from this historical bar chart, it is starting to falter, and we have been hearing a lot about job cuts from the tech sector, job cuts from various big conglomerates, as they try to make sense of trying to navigate their way through higher costs due to higher interest rates, as well as slowing demand from less sales. So the market expectations for the event is non-farm payrolls is expected to be showing 180,000 jobs created in April. It is likely to show a small tick upwards in the US unemployment rate, which still is quite low given how long and how strong the economy has been despite all the interest rate hikes from the Federal Reserve. One other statistics that is important is average hourly earnings. If it should show stronger than expected growth, then the Fed will be again fearful of wage inflation, which will add to price pressures and make them more likely to continue talking aggressively about their intention to keep inflation under control. So, of course, the way that the market trades is always in relation to expectations. So it is important to be aware of market expectations ahead of the data release. But our style is not to trade the markets based on digital outcomes, based on what we think the number would be, because there's a lot smarter people out there, a lot of more resourceful hedge funds and banks which have a better idea of what the numbers would be. So for the rest of us, we are looking at longer term trends and trying to find opportunities that are not so reliant on data releases, but more on the evolution of the fundamentals as well as technicals over a longer period of time. Again, happy to take questions, but we will be doing this for the rest of the month. So we'll be talking more in the days ahead about how fundamentals and technicals influence our trading. And we'll see you again on Wednesday on the midweek streaming from Trade Zone, sponsored by Eightcap. Thank you.